2025 budget roundup after a little hiccup 2 weeks ago. I suppose the good news is that we have a budget to talk to this morning. Perhaps the not so good news is that the bill that was tabled in front of Parliament yesterday still needs to be passed. So, we see the DA are still kicking and screaming, not happy with the VAT increases. So the question is, what now? Will that bill be passed? And that's the Rates and Monetary Amounts Bill that dictates the tax rate changes and the tables. So it's still a couple of days to go until we are certain that we're over the line. But at this stage, let's assume that we're on track and the budget as tabled is going to go forward, and we'll see those tax rates implemented. But exciting times, I must say, unprecedented. I was scurrying around looking at how votes happen, how Parliament decides these things, and how the budget moves through the process. And the bottom line is that our budgeting process in South Africa is incredibly transparent relative to the rest of the world. You have a look at the documentation that's available, the documentation that Treasury puts forward. It really is a very transparent process. But unfortunately, those that cast the vote ultimately need to align, and that's the issue. So I suppose there's still going to be some negotiation, but let's hope that the budget as we see it will be approved and will be passed by Parliament. So those that don't know me, I'm Dieter Schultz. I am the tax service line leader at RSM South Africa, and always very excited for the budget for this time of year. Anticipated tax proposals that are coming through, the Treasury are grappling with, and always exciting in the tax space as far as seeing what the budget is going to bring. So let's have a look at starting with some of the statistics, and I suppose the economists amongst us are always interested in the stats and where the contribution to government's coffers are coming from. Tax revenue for the current fiscal year, and remember the fiscal year of South Africa ends 31 March, so we're not there yet. So these are projections at this stage, but I'd say reasonably accurate. And we're talking about the year 2024-2025, so ending 31 March 2025. And budgeted tax revenue projections for the year are sitting at 1.846 trillion rand, compared to what was budgeted last year this time of 1.863. So you can see we're not quite there, 17 billion rand short. And it's always very interesting to see where that shortfall lies. And if we run through the details, somewhat surprising in certain areas, but in other areas quite predictable. So for me, a little surprising was the beat by 14 billion on corporate income tax. So what we're told is the mining sector struggled last year. Profits were down. As a result, tax collections were down in the mining industry, but other sectors made up for it. So there are nodes of the economy and business that did better than expected last year. And as a result, corporate income tax beat the projection by 14 billion. And of course, if companies are making profits, that means they're declaring dividends. And as a result, the dividends tax beat by 2 billion rand. Personal income tax was a bit disappointing. It had a shortfall of 6 billion rand, and that was notwithstanding the windfall from the two-pot retirement system that came in September. And if you recall, there was a lot of hype around it, and the sort of unintended additional tax that resulted from those withdrawals from the retirement funds. That number at the end of February stood at 11.6 billion rand, where SARS projected revenue of about 5 billion rand from those withdrawals. So quite a big beat on that front. So elsewhere, clearly the consumer, the personal income tax payer, is taking strain. And as a result, personal income taxes are short by 6 billion. VAT also fell short, and by quite a long margin, 17 billion rand. And we're told the main reason is that imports reduced significantly towards the tail end of last year and early this year, and mainly as a result of reduced import of solar batteries, inverters, as a result of load shedding having disappeared for almost a year. Unfortunately, it's back, so that might change. But interestingly, the demand for solar generated power equipment was far down, and as a result, that on imports fell short, and that accounted for most of the 17 billion shortfall. And then at the same time, as a result of load shedding disappearing, the diesel consumption demand was way down, and as a result, the fuel levy component of diesel fell short by 12 billion rand. So you can just see the impact of load shedding on the economy. And then excise duties, those are the sin taxes, were beat by 1 billion rand, and transfer duty also beat by 1 billion rand. So in total, that's where the shortfall comes from, and those are the elements of the tax revenues that beat and fell short. And then always interesting to see where our tax revenue comes from. And unfortunately, this trend kind of continues, is that personal income tax is by far the biggest revenue collector for government and has increased steadily over time. Personal income tax, 732 billion rand, making up 40% of total tax revenue collected. VAT, another big contributor, 25%. Corporate income tax, unfortunately, has been waning, and that percentage of the total collection has dropped over time, sitting at 17 billion rand. And then your other tax types, your fuel levy, customs duties, excise duties, all at 4%. Dividends tax, 2%. Skills development levy, 1%. And then taxes, transfer duty, 1%, and then other. So those are the elements making up the 1.8 trillion rand that government projects to collect for the remainder of this year. And then looking at, I suppose, the economists amongst us will always find this slide very interesting. And that tends to be our debt service cost as a percentage of GDP, our total debt as a percentage of GDP, and then how we fund our budget deficits. Where's that funding going to come from? So let's have a look for the current fiscal year, and then of course at the same time Treasury projects forward for the next 3 years at the same time, and total revenue projections at 1.8 trillion. Our total expenditure of 2.1 trillion means we run a budget deficit of 352 billion rand for the current year. That 2.1 trillion includes interest servicing costs, so debt servicing costs, interest. And currently, those debt service costs as a percentage of GDP are 5.2, And you can see that that number is kind of sticking at that number, at the 5.2, 5.3 range for the next 3 years. And that puts big pressure on the economy. It's about 400 billion rand a year, and that's a big number. The one good thing is that our deficit doesn't exceed our interest costs. So we're still spending what we earn essentially before interest, and that is some positive to take away from this. But it certainly it doesn't relieve the overall pressure and the pressure cooker that is mounting. The debt that the country's got, 76% of GDP, has to be serviced clearly. So the repayments for this year that we're seeing coming through on domestic and foreign loans, about 100 billion rand we have to repay. The Eskom debt relief arrangement, we saw that come through last year, and there've been some tweaks there, but 64 billion rand we had to cough up this year, another 80 next year. And then remember the excitement last year around government finding this pot of gold in the gold and foreign exchange currency reserve account. And they've tapped into 100 billion of that this year, another 25 next, and 25 thereafter. Which now means the country's got to find 415 billion rand. Where are we going to get it from? Well, debt. So that's where we're going. The good thing is that we're still sourcing most of our debt domestically. And as a result, we're not susceptible or largely susceptible to currency gains and losses, which adds a whole element of risk to the country. So if you can see here where we're going to be funding the 415, most of it comes from domestic debt, some of it foreign, and then some of it out of our cash reserves. And then, interestingly, looking at where our GDP numbers are projected to go over the next 3 years, we're sitting at 7.5 trillion this year. And everything is kind of reported as a percentage of GDP. So that's the snapshot of the country's kind of fiscal position. Let's then have a look at the numbers of personal income taxpayers and who's contributing what to the personal income tax revenue collection target, and that's 800 odd billion rand. And if you have a look there, you'll see we've got 14 billion registered taxpayers, of which 6.5 billion don't pay tax. So employers are required to register their employees for income tax, and 6.5 billion of those earn below the tax threshold that sits at about 96,000 rand per annum. The rest that are paying tax are made up as follows. So these are numbers of taxpayers, and you see by far the majority sit in the under million rand a year earnings mark. Those that earn over R1 million, so we're talking, 560,000 people odd, contribute about 50% of the total tax revenue. So of the 14.4 million registered taxpayers, 570 odd thousand contribute almost 50% of total tax revenue. I think we know that. A very redistributive budget, if you want to call it that. But unfortunately, that's what we are living with, and that's a fact of life. Okay, then let's move on to the tax proposals and what came through. So we saw that government are looking for 28 billion rand in additional tax revenue next year. And they're going to source that. I'm going to go through the highlights of where that's coming from now. And what they've done, and remember 2 weeks ago, we had the no show as a result of the disagreement around the VAT increase. And what they've now kind of done in hoping to reach the compromise is spread the VAT increase, not go the 2%, but go 1%, and spread that 0.5% this year and 0.5% next year. So from 15 ultimately up to 16%. But every 0.5% VAT increase gives about 14.5 billion rand to the fiscus. So part of the 28 billion is going to come from this 0.5% effective 1 May 2025, and then another 14.5 in the 26-27 fiscal year as a result of that additional 0.5% increase. Of course, we know the impact of VAT on the economy. It's a tax on consumption, and it hits the poor most, any increase on that score. So to compensate and alleviate some of the hardship, what we see is the list of zero-rated goods expanded, and we'll have a look at that shortly. The remainder of the 28 billion is going to come from no adjustment to the income tax brackets, the rebates, and the medical tax credits. So unfortunately, absolutely no adjustment in those areas. And that gives the fiscus about 19.5 billion rand next year. I suppose there's a bit of give and take going on here. And we've seen no increase in the general fuel levy. So that's good news. However, those of us that enjoy smoking and drinking, the sin taxes have increased above inflation. So we'll have a look at that just now too. And then importantly is, there's been a little bit of argy-bargy between Treasury and SARS, because Edward Kieswetter is determined to modernize and improve the SARS administration system, the collection mechanisms, and he's doing a pretty good job at this stage, but he needs money. And Treasury have agreed to allocate a couple of billion rand to SARS again this year for that exact process. So we think that SARS have improved in terms of their collection mechanisms and their collection efficiencies. That's going to continue, no doubt. And they're using technology more and more, and we're going to see improvements in that area. So just be aware that that's coming. Okay, let's go and look at the specifics then. And starting with VAT, the big talking point, as we've already mentioned, 0.5% effective 1 May 2025, 0.5% effective 1 April 2026. Both of those are in the draft bill. So already enacted, that 2026 change, well, sorry, not enacted, proposed. Those bills still need to be enacted. So we see, to compensate, an increase in the basket of 21 zero-rated food items that are in place at the moment. That 21 is going to be increased. And first off, edible offal from cattle, poultry, sheep, goats, and pigs are going to be added. Dairy liquid blends are going to be added, fat-free, full fat, etc., etc. So I assume that's a drink. And then tinned or canned beans and peas are also going to be added. So obviously targeting the poor and trying to offer some relief there. And that's just to give you an idea of what that's going to cost government. They're estimating about 2 billion rand is going to be the impact and the cost to the fiscus of zero rating those additional food items. Importantly, those of you running businesses, the transition of any VAT rate change is a nightmare. So we need to prepare ourselves. We've been given some time, so 1 May 2025, so we've got till the end of April to make sure our accounting systems can cope, our reporting systems can cope, and we're able to navigate the change in the VAT rate. Remember last time the VAT rate increased was in 2018 when we went from 14% to 15%. And it really was a challenge. Look, we hadn't seen a VAT rate increase since 1993 prior to that. And so I think we'd forgotten, we got a bit lazy. But the bottom line is we need to make sure our accounting systems are up to speed to deal with the transition. And remember what happened last time, the VAT returns did not cater for the changes. So in those first couple of VAT periods, May, June, we're going to have some suppliers at the old rate, some suppliers at the new rate, and the VAT returns don't deal with it. So we need to now start planning for how that is going to work. We need to start pressing SARS as to what those returns are going to look like, and are they going to be able to deal with the two VAT rates? My guess is not, and we're going to have to do the same as we did last time, and that is just make sure we've got the workings to support those first couple of VAT returns. And then very importantly, the time of supply rules. You're going to have certain transactions at the old rates. You've got agreements that you've entered into prior to the change. Just bear in mind, you've got some protection mechanisms in the VAT Act that allow you to change the VAT rate if there's an increase. So we need to use those. And then bearing in mind, people are now going to play games to get the reduced to get in before the 1st of May at the reduced VAT rate. Beware the anti-avoidance rules. Yeah, it's going to be fun and game for your finance teams for a while, but that is what it is, and it adds a bit of excitement to the whole process. That's assuming the bills pass through Parliament. Okay, let's then move on and have a look at personal income tax. What's happened there? Absolutely no change to the tables. So the tax thresholds remain the same. The rebates remain the same. So I'm not even going to dwell on those. Monthly tax credits for medical aid contributions, no change. 364 per month for the main member and 246 per dependent thereafter. And sorry, that's 364 for the main member and first dependent, and then 246 thereafter. No change in the CGT rates. I think there we can breathe a sigh of relief because there was an inkling that might be tampered with. But our 40% inclusion rate remains, and our annual exclusion of 40,000 remains. And then the interest exemptions don't change. What is quite important on the personal income tax side is the treatment of foreign pensions received by South African tax residents. And these have always been exempt in the past. Treasury has been mumbling about this for a long time, and there's avoidance of tax going on here. So what they're proposing to do, and we haven't seen the details yet. We'll see those in the draft bills that are yet to come out, but it's likely that foreign pensions are going to become taxable, and you're going to need to look to the double tax agreement with that particular country in order not to exempt or to reduce the tax, claim the credit in South Africa on any foreign taxes that are paid on those pensions, or whether that pension might still be exempt from tax in South Africa, taking into account the articles of the double tax agreement. So that's one to look out for, because there are many people that are receiving pensions as a result of employment before they arrived in South Africa. Then those of you that are involved in employer-provided accommodation, so this is where your employer provides residential accommodation for an employee. The value of the fringe benefit of that accommodation provided is calculated in terms of a formula, and one of the elements is the remuneration proxy, which has excluded Section 1010 exempt income previously. That is the income that is exempt from tax in South Africa when you're working abroad. And as a result, there's been some unfairness around the calculation applicable there. So that will be taken into account in future to make it more equitable, which is good. And then just bear in mind the travel allowance table's been adjusted, and quite bizarrely, we see the fixed cost go up. We see the fuel cost go up. And sorry, fixed costs come down and the fuel costs come down and the maintenance element go up. So just be aware that those tables have changed. And then I think one that we can be quite thankful for, the transfer duty tables have been extended. The bands have been increased by 10%. We saw an increase come through in 2024 around transfer duty. So bizarrely, it's the only table that they seem to be factoring inflation into the rates. So the actual tax rates themselves in each of the bands don't change, starting at 0 up to now 1.2 million rands worth of the sale value of the property, and then going 3%, 6%, 8%, 11%, and 13% over a sale price of 13.31 million rand. So we'll take that, and then just bear in mind that becomes effective 1 April 2025. Fuel levy, as we saw, no change. And just interesting, for every litre of fuel you put in, what are you giving to government? Well, at this stage, 6.18 rand for petrol and 6.06 rand for diesel. And that's going to increase as a result of the carbon tax increase, interestingly enough. Only that element has increased. So the rest of the general fuel levies not, but the carbon tax element has increased. So a tiny increase coming through there. And I think, yeah, that we'll take. Sin taxes, we saw a slightly over-inflationary increase, 6.75% on most of the alcoholic beverages. And then some of the cigarette tobacco items were spared at 4.75% increase. But also that's coming through shortly. I think 1 April was the effective date that those changes come through. And then moving on to corporates and business and the changes that are proposed there. I must say this year, very specialized, very niche. So not a lot here that impacts all of us. But let's run through the carbon tax proposals. If you are involved in that space, just have a look. Discussion paper was published in November 2024. There are various budget proposals around the carbon tax, so just take note of those. Again, anyone in the farming, mining, forestry industry, the diesel refund system is going to be simplified from 1 April, some quite big changes coming through there. So that's good to alleviate the administration in that process. So look out for that. Collective investment schemes, your unit trusts and the tax treatment of those, there's been a major concern for the actual trust itself and the tax implications for the trust. Treasury has acknowledged that and accepted that they don't intend taxing all, I suppose, gains or investment returns in the trust as revenue. That's not the intention, and consultations during 2025 will continue in that regard, and we'll see some clarity coming through. So that's good news. Section 20 Cap A, this does impact a number of us, and those are, that relates to the ring fencing of losses on certain trades, and typically that's where you own rental property. The rental property is making losses and you're earning other sources of income, salary, investment income, etc. The question is whether you can set off the rental loss against the other taxable income. And Section 20 Cap A is an anti-avoidance provision that kicks in if you're earning taxable income above the marginal tax rate. So about 1.8 million rand a year you need to be earning in order for the ring fencing to be applied. SARS is concerned that many people are slipping out of the net, and as a result, the losses are not being ring fenced, and they will reduce that threshold. So beware that ring fencing might be applied more broadly in future, and in fact, it will be applied more broadly. But again, let's have a look when the bills come out as to the impact there. The VDP program that's the voluntary disclosure program, is to be extended to customs and excise transgressions, and that's a good thing. So if we pick up an error and we approach SARS, we can enter into an agreement and avoid the penalties. And then importantly, your employment tax incentives, if you are claiming those and you're involved in that, the formulae changes, the thresholds increase from 1 April 2025. So just go and have a look at that. And then finally, because I see we are a little over time, finally, trusts. So just remember, 1 March 2024, we saw that significant change where income distributions are made to non-resident beneficiaries. The trust now picks up the tax at a flat rate of 45%, in the same way that capital gains are treated, and the after-tax amount can be distributed to the beneficiary. This has resulted in unintended consequences for foreign beneficiaries of South African trusts. Treasury has acknowledged this. The ability to claim a tax credit in their home country is a problem. And then also the withholding tax on dividends, applying double tax agreements to reduce the rate, which should be the case. But because of the way the wording of the section works, is you can't avail yourself to the relief and the reduced rate. So that those elements are going to be looked at in future, and I look forward to that because this is a problem. And then finally, just bear in mind that those of us with trusts, 30 September 2025 is looming. Your IT3T tax certificates have to be filed by then. And that relates to the year ended 28th Feb 2025 and must include all distributions that are made, both taxable and non-taxable, to beneficiaries of the trust. It applies to all trusts. 2024 was the experiment year, was the test year. We're now moving into the real game, and we can expect enforcement from SARS. So just be aware, very tight timelines. We need financial statements prepared. We need information to be able to prepare the IT3s. So the timelines for trusts is under pressure. So just bear that in mind. Great. And I think then, apologies for keeping you 3 minutes over time. But if you do have any questions, feel free to shoot them through via email. If you've got any comments, observations, suggestions, please feel free to send them through to me, and I'll gladly deal with them and correspond with you outside of the session. But again, thank you very much for attending. Exciting times and uncharted waters as far as the budget's concerned, but enjoy the rest of your day and see you next year this time. Cheers.